Hello, everyone, and welcome to Profiles in Risk. I am your host, Nick Lamparelli. On this lovely summer day, I have a full panel of guests for the Internet of Insurance Conference that's going to be held in September in Houston, Texas. And this is going to be a preview of that particular conference. Circling around clockwise from my left over here, I have Brian Gaab. Brian is Principal of Strategy and Innovation for CSAA Insurance Group, a AAA insurer. And he is based in San Francisco. Immediately to my right, it kind of feels like the Brady Bunch. To my right, I have Ellen Dolan. Ellen is the newly appointed Head of Content and Program at the Internet of Business, based in Boston. On the lower left, we have Newcombe Clark. Newcombe is the Global Director of AIG's Rapid Learning Lab, and he is based in New York City. And last but not least, I have Dorothea Westin. Dorothea is the President of CSRisks, a professional and management liability niche specialist, and she is based in Atlanta. Hi, everyone.
Hi, how you doing?
Good morning.
Ellen, I want to start with you as the one that's sort of responsible for heading up this conference. Why don't you spend a couple minutes and talk about the Internet of Insurance, dates, places, and give us a general gist of what this conference is going to be all about.
Yeah, so the dates are September 26th and 27th in Houston, Texas, like you said. It's a really fun event. One thing that we try really hard to do at the Internet of Business is to make sure that all of our events are really interactive. All the sessions are going to be about 20 to 25 minutes long. So all these speakers, hopefully you get to see and hear from quickly and then get to talk to, because we do a lot of networking events, but like pre-event, throughout like networking meetings, and then we do some cool post-event stuff. I'm hoping we actually get to go visit the Houston accelerators and actually get to hear some more pitches from startups.
Yeah. Could you describe what precipitated the event?
So Internet of Business always works in verticals of like manufacturing, insurance. We do this really cool event called Internet of like Build, which is all types of startups and different ways of using technology. But the way we sort of came to this event, this is the third year of doing it. It's just insurance is ripe for disruption. There's all different types of technologies that are being used between IoT, AI, blockchain. And we think people want to learn about that, especially within the industry, and they want to learn from each other. So that's what we try to set up.
That's fantastic. I'd like to go around the horn to each of you, Brian, Newcombe, and Dorothea, and talk about your particular panel. We'll do ladies before gentlemen, Dorothea, and then we'll go over to Newcombe and then Brian. What is your particular presentation or panel discussion going to be about? And perhaps also, while you're doing that, talk a little bit about what you do on a day-to-day basis.
Okay. So I am a professional liability niche specialist, which basically means that I work with carriers to find the right coverages, to explain the right coverages that they're offering to agents and insurers, usually specialty coverages. So one of my areas of practice is what we call cyber, or privacy and network security. I've worked with companies on what exactly it covers, because a lot of insurers don't necessarily understand that. And as we grow the AI world, that will change over time as to what each policy will actually cover. So the session that I'm on is how autonomous driving, ride-sharing industry is impacted by traditional auto insurance business models, along with liability for those vehicle drivers, will change. That was a long title.
What do you expect to be discussing on? Why should someone attend?
So what I expect to be discussing is how we're seeing new exposures evolve. For example, with ride sharing, traditionally speaking, if you work for a fast food restaurant, your personal auto policy did not cover you. You had to rely on them. Uber has its own policy and Lyft have their policies for their insurance, but there's a gap between when your personal coverage will cover you for your driving and when Uber or Lyft's coverage will kick in. And it's called stage 1 gap. And there's actually a policy now to fulfill that stage 1 gap. So insurance is not cutting edge. It is, traditionally speaking, more conservative and a little slower to respond because you have to kind of wait and see what's really going to be a problem. So we're learning as an industry to respond faster and how to handle the changes in liability and then write appropriate coverage forms for them. And that's a little bit more about what we're going to talk about is how can you make sure that the things that you don't know that are going to become a problem, we can protect you for them. Good.
I like that. It's really interesting. Newcombe Clark, what are you going to be discussing?
Ellen, you may need to help me on the title, but I'm going to be participating in a panel and then actually also doing a case study. The Rapid Learning Lab is essentially an applied science team within AIG. So we're a mixture of kind of traditional consulting backgrounds and data scientists, and we're meant to create platforms and projects that follow the scientific method. And the Rapid Learning Lab is using statistical design. We try to make these experiments very efficient to try to figure out what works and doesn't work, all with the goal of driving profitable revenue growth. So in the digital space where there's quite a bit of data in distribution, marketing, that's a natural fit for our team and the type of work we do. So I have a feeling what I'm going to be talking about both in the panel and the case study is the way the team thinks about the data we collect, how we actually utilize it, and then hopefully it's relevant, drives actual and revenue and profitable growth.
Yeah, that's really interesting. I always, it's amazing to me that you see the scientific method obviously used in science and in engineering and areas like that. I've seen it in marketing, where there's a lot of testing, statistical areas. Haven't seen it a lot of in insurance. So that actually seems like it's quite innovative for such a conservative industry.
Yeah, and we're definitely not a one size fits all tool. As Dorothea mentioned, right? You kind of, from an actuarial science standpoint, you got to put something out there and wait for the claims to come in or not. But there are aspects of our business where you don't have to wait, especially when it comes to marketing and selling online. So, if you take some of our major airline partners where we're actually selling travel insurance when you book your trip, those are, immediate decisions where we're making an offer to you of a product, a price, the content of that offer. All of that can be analyzed, and the data that comes through, the type of travel, the segments, all of that can be fed into creating something that would be kind of synonymous to a Netflix for travel insurance, where you're getting the right product, the right price at, instantaneously.
Yeah.
There's a lot behind the scenes to make that work, but but it should and it does happen real time.
Okay, that's awesome. Brian Gaab, could you talk about what you do and also what you'll be presenting on?
Yeah, absolutely. So I work for CSAA Insurance Group. We branded the marketplace as AAA and write AAA auto and home insurance in 23 states in Washington, D.C. So definitely coming from bringing a personal lines carrier perspective. What I do is I lead our core innovation practice, and what that means is basically new products and services or larger scale radical changes to our existing products and services. And those are, when I say core products, I'm really talking about our home and our auto product, what AAA is pretty much, known for in the insurance world. And so what I'm going to be talking about, I think that the title of my my session is rather long, but it begins with infusing a carrier with innovation. And I think that as we touched on, I think at the beginning of the session, I think Nick, you brought this up, is that the insurance industry has been slow to change for a variety of reasons. You could talk about them being in regulation or lots of different things. And if you look at the top 5 carriers in various different spaces, you haven't seen a lot of changes in many, many years. Whereas if you look at other industries, it's quite different. And so, what I'm going to be talking about is basically some changes that we've made at AAA specifically, and some both opportunities for kind of larger scale radical changes within our existing products. For example, I'll talk about a partnership we have with Lyft, the ride-sharing company, as well as new products and services in the personal line space.
Awesome. Insurance is all about data. And this conference is, at the end of the day, the Internet of Insurance is about all these different forms of data. And we've done over 100 podcasts on profiles and risk. And something that pops up again and again are the legacy issues that carriers have with data. And so I want to go around the horn again and talk about specifically, like, as someone that's in the industry, I love what it is that this technology brings. My biggest concern is that the technology, it's like drinking from a fire hose, to use that business cliche. Ryan, we'll start with you and we'll circle back around. How can companies that are dealing with legacy issues today, currently, how are they going to be able to handle the types of data that are going to be coming? Maybe you can even touch on the different types that are going to be coming, the different fire hoses. But how can a company that are going to be, they're going to probably fear all of this data because they can probably barely handle their own.
I think you hear a lot about data scientists today. It's a super popular job. If you can have that in your job title, it's a huge advantage to you. And data scientists are incredibly in demand. It's an interesting kind of newer field, but I actually don't think it's a new field. I think the original sort of data scientists have been around for quite a while, and we call them actuaries. Actuaries' job is ultimately to basically combine a portion of statistics and mathematics and take various data fields and make sense out of them and predict what ultimately is going to happen, which is what data scientists are doing now. So I would argue that from a big data perspective, insurance carriers in general, the insurance industry is sort of the original big data organizations of the past, and I think that's both a competitive advantage and a disadvantage at the same time. The advantage is that we have a lot of the smarts, so to speak, to ultimately be able to interpret new forms of data. The downside is that we've looked at the same data for a very, very long period of time, and we're not necessarily always used to looking at new streams and new opportunities of data. I also think regulation plays a role. There's in the personal line space, at least, I could speak to that, a significant amount of regulation around what can and can't be rated on and what can and can't be used in the process. But I think that in general, what we're starting to see is carriers start to dabble in these new data streams. We're seeing whether that's let's say the connected home and for personal lines insurance, or many other streams that I think my other panelists can speak to around those different new types of data. But I think historically speaking, we haven't been great as an industry at dealing with new forms of data, and I think that's kind of slowly starting to change. So
Newcombe, you work for AIG, one of the largest global insurance companies,
and the oldest.
And what I would imagine if I were there, I would say, here's this rapid learning center, and they're going to be pumping data at us so quickly. We can't, how do we handle what we have now with this new stuff that's coming in? And Brian brought up trying to tie the new data to a product or claims, or make something useful of it. What's your feeling? So what's the what kind of gossip goes around? What do people mutter under their breath about rapid time at AIG?
I definitely would want Brian to come referee the next conversation between my team and the actuarial teams. No, it's I think any tension, if it exists, or consideration, I wouldn't call it a concern, between what is tried and true, been around for hundreds, if not thousands of years, actuarial science and math, versus what may be viewed as, more novel uses of, again, math that's been around for a while. I think that collaboration is important. Give an example I often use. So if you flip a coin 100 times and say it only comes up tails 20% of the time, if you were looking at the kind of risk pool of of it being a tail, you're going to see a 20% risk pool in that, right? That would be your loss ratio in that insurance pool. Now, we kind of all know that the probability of a coin flip in a controlled experiment is not going to be 20%. But would you define your risk pool? Would you rate your product for something that had a 50% risk if none of the data suggested that? You'd have a huge opportunity cost, and you'd leave a lot of potential margin on the table if you plan for a loss ratio of 50%, but your data only suggested 20%. So it's kind of two different ways to look at it, where the dance comes in, and this is also where legacy comes in, is how do you partner up the, potentially different approaches, potentially different cultures, to make sure that you're maximizing and optimizing, not only the customer experience, but the business potential. And there are places where it's a lot more natural, like I mentioned, marketing, where really you're risking kind of your marketing expenses or your opportunity costs in terms of showing the wrong thing to the wrong person. But then also, if you have data at the front end, you can start to think about your distribution and your risk pools. So if you see someone kind of coming through the pipe that might have an adverse effect on your risk pool, you can pull some levers at the front end to balance the risk and profitability on the back, because you have the inputs from the actuarials. So I try not to promote the conflict if it exists. That's not to say it doesn't exist, or at least there's not a consideration. From a standpoint of it being legacy, I don't think you ever can be free of legacy. Even if you start from scratch, you're still going to come in with a culture, and it's going to either be defined by the leadership in the organization, or it's not going to be defined, and that in and of itself is culture. So I think it'd be nicer sometimes if I was working with newer technology and perhaps people that are of more similar generations, or look at data science in the same way. But I also wouldn't have the opportunities. Our team would not have the opportunities. Our company would not have the opportunities if all those pieces aren't put together in the right way. So, we don't have an option to kind of, take our toys and go home. We have to play together. And when we do it right, we can leverage the strength of our organization and our industry, and also the new things that we bring in. Yeah. Rapid Learning Lab's only a year old, so you maybe ask me in 5 years and count my gray hairs if I've made progress.
It's a deal. I'll send the calendar invite for 5 years. We're going to track that. That was a great response. Dorothea, same question, except it seems like in your particular field, it's very liability oriented. So I've seen a lot of data dealing with auto and property. I haven't seen a lot with liability. So I think you're also in a very unique perspective in terms of the types of data you're trying to get, bringing it in, but also wrapping it up into a product that traditionally has been looking in the rearview mirror, since the beginning of time, and try to be forward looking. So what's your perspective on this?
So I thought a lot about this question, and in truth, when you look at, dealing with most of the coverages I deal with start with a lawsuit. There's either a physical incident or an emotional incident or a personal injury that has occurred that leads to where the policy is triggered. And you go back to, is the data that was entered accurate at the beginning? If you want to take it in terms of auto, if you get one of those little doodads from AAA or whoever, and you put it on your car and it starts tracking your information, well, that's great. You have wonderful driving history, but what if it's the grandmother's car and not the son's car? And then the son has a car accident, and the tool isn't there is that fraud? Is that just a mistake? Some of those things will play out, but the data has to be trusted. And I think that that's the critical thing for us to figure out from various lines of insurance coverages, is how do we know that the data that's going in is valid, accurate to the insured risk or to the insured user? And then when it is accurate, how do we choose the right data to underwrite from? I recently helped put together an underwriting program for errors and omissions, and there is a huge difference in philosophy as to what is important information in trying to understand where you're going to find your rates. And it goes back to the actuarial. You have to be able to prove to an actuary, this is how many accidents or incidents or problems that you think that you're going to have. And this question is going to tell us if that's going to be a predictor of that or not. And it does take time. It takes time to build that information. So it'll be interesting. And we are getting information from various places that can tie together, but there are, just as Brian said, there are huge regulatory concerns. And for just protecting information, we've seen hacks in the system. We've seen people breaking into computers. So I think it's going to be a very interesting time. We live in, as the Chinese proverb goes, may you live in interesting times. We live there now.
So, Dorothea, while we have you, it's going to take time. Okay, how much time? So I'll give you an example. I had someone on my podcast, and we talked. You know, I'm big in natural catastrophe, so I deal with flood on a day-to-day basis. And this particular gentleman said, "Oh, it's a 100-year problem." He's like, "We're not going to solve all these problems for 100 years." And I was just like, "Wow, that's depressing." So, you know, data is it's rapidly coming. Is this a 5-year problem?
Listen,
10-year problem?
You know, I started in the industry. I'm going to show my age here. I hate doing that, but there's no other way to tell you this story without doing it. I started in 1991. The fax machine was brand new. It was so exciting because you could now write corporate insurance in 2 weeks instead of a month. And then we got email, and you could write it in a day. And now we have portals, and you can write it pretty much as soon as they finish typing in the information. The trick is, and I think what you're going after there with asking how long is it going to take, is how long will it take us to get to that valid and useful information that when we process it immediately, it sticks and stays, and it was the right choices. So if we as an industry analyze well, create good systems to capture the right data, which there's always the trick, the right data. I really believe that many parts of insurance will be fully automated in the next 3 to 5 years. And really 5 years, it'll probably have migrated again to a different platform because it's just exponential, the shrinkage of time to accomplish these things.
Yeah, so Newcombe, I'm thinking smart homes, connected homes, telematics, with a voluminous amount of data that's coming. I would say that the data is obviously there. It has to be processed by divisions like you have, teams that can kind of process that and put it all together, and then kind of stitch the product. Do you feel the same way? Do you feel we're just basically turning the corner and we're going to be there where there'll be products where the rating of the product could be potentially like on a day-to-day or month-to-month basis because the data that's coming in to feed the rating is coming in almost in real time?
Assuming you have the product filed, then yes, you have the ability to be much more flexible in terms of what you offer to whom and when based on the data that comes in. So I think we're seeing better success in being more flexible at the regulatory standpoint up front. Similar to kind of how we structure our experiments. We're a big proponent of DOE, design of experiments, which allows us to essentially conduct our research and get a lot more results a lot quicker than kind of traditional testing. So if we have everything set up well up front, right, we have good, strong regulatory buy-in and guidance. We have bulletproof data security. We have attorneys that are very comfortable with what we're doing, and we believe we should do it, whether or not we can do it because it meets the needs of our customers and our intermediaries. Then you kind of set everything up, like a well-run restaurant, and then you can move very quickly. I think where people fall down in executing these type of projects or dealing with big sets of data is they assume that getting all the approvals and all the setup is what you do at the end, and after you've already designed and engineered it. And so we flip everything over and say, get everyone to say yes before we spend any of our time and money trying to stand something up. And then once it's stood up, once our laboratory is set up, we are able to, in that very controlled environment, produce results a lot quicker than if we had.
Yeah. Brian, getting approval, regulation. I'm already you can already imagine from like a smart home type of scenario, there's going to be, you're already seeing Alexa capturing people's conversations, right? There'll be cameras installed in homes. I mean, smart home's going to have cameras. It's going to be collecting audio. It's going to know how much water is flowing through the house, all of that stuff. It brings up a regulatory aspect where you guys could be collecting the data and you may not be able to use it because the regulators may not allow you to use it. What's been your experience so far in dealing with data and regulators?
I think that no doubt regulation's a big part of it, but I would actually think about it first kind of in terms of the challenges to the carriers and the customers, because I think regulation follows those two. So as I think about kind of the, when we think about sort of adoption, you mentioned next to home or more broadly speaking, IoT initiatives in general, you're dealing with, I think on the carrier side, at least sort of two things. One, we touched on it a minute ago, and that was the ability to sort of believe the data that you're getting. I think Dorothy kind of talked about a scenario in which, unclear as to who was driving the car. That's a situation in which a carrier doesn't have a high level of confidence, or shouldn't have a high level of confidence, in the data that they're receiving. We also have an actuarial relevance sort of component to it, right? At which point, at how many million miles, or at how many different data points do we as a carrier ultimately believe in this new data stream, that it provides value, that it actually statistically means something? And then when we think about from a customer perspective, this is a really interesting one, I think, because over time, over the last, let's say 10 years, I think we've seen customers in general become significantly more trusting of companies having access to data that they didn't before. You mentioned Alexa. That's a great example. Now, I think a question still remains as to whether they're comfortable sharing that with their insurance carrier, because now we've gone from, hey, Amazon, who I buy things from, to the guy who's going to tell me if I get paid on a claim or not, right? So there's perhaps a different component to that. But I really think that your original question about sort of regulation, I think regulation is going to follow those two factors. It's going to follow the impediments and the advantages that carriers see in this space, and the impediments and the advantages that end customers see in this space.
Yeah, I bring up regulation because I think of the classic credit risk scoring and how that was brought into insurance, and there was a big fight in order to get credit risk scoring to, I think from an actuarial standpoint, it was put in, and I think the companies felt comfortable with it, but it took a long time for the regulators to accept it. And I still see consumer groups claiming that credit risk is, what does credit risk have to do with property losses? There's still that fringe element. And so there's still a part of me that feels like, the three of you could do a ton of great work, and there could be a regulator that wants to make a political stand and just say, we're not going to allow you to tie those things in together. Especially, Brian, you brought up everyone will share the data if premiums go down. But if premiums go up, there's going to be, peasants with the pitchforks over at the State House, complaining about it. That's my experience, and that's my biggest concern when it comes to regulators. Any thoughts?
Oh, no doubt. I mean, AAA is one of the largest auto insurers in the state of California. The state of California is pretty much, I think, maybe one of a very small number that specifically do not allow credit to be part of the process.
There you go.
So in the 22 other states that we write in DC, we use credit, and in the one in our home state where I happen to be located right now, we don't. So the short of this is that yes, I think that there may be a point at which we get to carriers and customers are comfortable with this, and regulators come in and say no. I mean, I think if you I think a lot of it does have to do with the political wins. So, so is that going to be a factor? Absolutely. You can't really predict that, though, and I think that I don't think that that's going to change a carrier or customer, intention on this. It's not going to really impact product development life cycles, other than to say that when you start seeing the writing on the wall, you may react to it accordingly. But I don't think it's going to stop. I don't think it's going to be an impediment to the innovation in the short term. The what if they don't let us sort of a thing, right?
Yeah. I want to bring up. Oh, Dorothea, go ahead.
I did want to say too that regulation oftentimes starts out as one topic. So you look at ADA, for example, when it first came out, it had a huge impact on insurance and on the workplace. And the goal was to allow people who had handicaps, physical handicaps, to have free access to work. But it also ended up protecting people who had drug addiction, who had a disease. And so it was broadened, that regulatory rule was broadened as it was implemented. And I think you're seeing that now with privacy and network security, where specifically, if you look at the state of New York, California, sorry, New York's got the edge on this one. They've implemented pre-loss regulations now, where their financial institutions in that state are to be compliant with how they're protecting their information, not just verifying it after an incident. So I think regulatory matters as a whole will change, as if that is successful in New York, we will see other states do that. And it won't just be for the financial industry. It will ultimately, blossom out into other industries as well, where it's healthcare, where it's any data that they feel as a citizen needs to be protected.
Yeah. Speaking of the citizen, Newcombe, your presentation specifically on the customer. So let's talk about the customer. I would probably consider myself an early adopter. I would love to be able to set up a smart home and connect my insurance policy with it. What's the, in technology, there's the concept of the minimum viable product. What's the one product we can go out to market to kind of test our hypotheses? You mentioned the scientific method, test our hypotheses, collect feedback, and keep improving the product in that fashion. What's the best way to create a product in this area? Is it to target early adopters? Insurance traditionally has struggled with wanting a product that's scalable from the start. But as Brian and Dorothea have mentioned on several times, the data's coming at you in voluminous amounts. You don't know if you trust bits and pieces of the data, so it's going to take time to put that all together. Who ultimately is the appropriate customer for the insurer to create a product for?
So I think I mentioned, having flexibility in your product at the beginning. So, not only do you have lots of things on your menus, but then to your point about testing and minimally viable, this gets a lot easier in the digital space and digital distribution, and not just when you're selling direct, but the data available and the kind of real-time response of what works and what doesn't, in terms of gauging interest, all the way down to people actually quoting and binding. This gets a lot easier online. So I think by that very nature, a lot of what we do is in the digital space. But that's different country by country and customer by customer. I mean, we often, what seems to work in one place, we're always surprised. We shouldn't at this point, but we're always surprised how different something works in another. The thing that compels someone to get a quote on our auto product in Malaysia is vastly different than what compels someone to get a quote online for auto product in Ireland. We'll set up the tests, we'll run, scenarios through that and experiences to see what it is that works. But what we know that's minimally viable for us is setting up the ability to run our test and have trust in the data. It is very, very true that you garbage into your model, you get garbage out from a data perspective, which is why we focus so much on that initial setup. And we don't test if we can't measure it. We don't invest if we can't measure it. Often it needs to be at a disaggregated level, and that often means that some things we just are not the right team to jump in. Previous to AIG, I was at Nielsen, where they are sitting on a ton of data in terms of what people watch and what people buy. And a lot of the work that we did there, even if you could find that perfect thing, you were limited by the ability of the tools, the technology, and essentially the marketplace at the time to execute on it. So I think it gets, as we try to kind of control our little sandbox, we also see the availability of these tools and the expense in standing up something that is kind of MVP gets faster and cheaper almost every time we try it.
Brian?
Yeah, I think that as I agree with Newcombe, what Newcombe was getting at. To me, it feels like if you look at other industries, you see other industries being able to get pilots together and execute in the work in the market very fast. Get something to market, try it out, get customer feedback, iterate on it, repeat, kind of a process associated with that. One of the things that we at AAA are trying to do is we're trying to do that with insurance too. It's not exactly the same, and it can't be the same, because ultimately what we're doing is we're selling a product, and a product that is in a lot of ways similar to the type of iterative process that other companies can go through. But we also have to sometimes, in certain situations, file these products, and then get a certain amount of, perhaps a higher threshold than other industries might require in some cases. So we're trying to be kind of nimble and create these MVP type of situations as well. I'll give you an example of that. We have a ride sharing product for folks who drive for Uber and Lyft, right? That's a product that we introduced a couple of years ago. We've made modifications to it, but it's not quite the same. It's let's say years instead of weeks or months, right? So I think we're doing everything we can to shorten that cycle time and kind of increase the knowledge in as getting it as quickly as possible. So anyway, I think there's something to that.
Basically, what you're saying is insurance isn't an app.
No, it's not, and it requires a lot more than that, and so as we can try to emulate that as much as possible, and we can really try to get feedback and modify products as quickly as we can, given additional constraints.
Dorothea, does it help? You're dealing in what you've described as a niche specialty. Does that help?
Well, what it means is you have a new star every day. It's whoever figured out the model for the coverage line that you're working with right then. So it used to be that we did policy analysis and we would look at the coverages and say, AIG's offering this, RSUI's offering this, CNA, Chubb, they're all offering these various things. And you could count on, well, this is what this one has, so you know which one has the best of whatever you needed. That's not the case right now. Policy forms are coming out so much faster, in part because they are trying to find where the arrow's going. The rating models behind them, apps are changing. You didn't have a change in an application for 5 or 6 years. Now applications change, with the click of a button online. So I think that will help with the predictiveness, but it means that there's really a lot of for the agent, for the insurance agent, it means they have to really look at what they're doing and who they're doing it with to see if it's the right product that's now available and if it's the right product that they can sell, that they know.
Yeah. Yeah. I want to stay. Oh, Newcombe, you have.
Yeah, no, I just to your kind of question and point of insurance is not an app. I think from a product standpoint, that's true, but I don't necessarily think from call it a philosophical standpoint, right? If our customers don't want a claim and we don't want our customers to have a claim, and there's knowledge or information, call it data, that could get ahead of that, not just to analyze it after the fact and then change the product, which takes time, but get ahead of that to mitigate and avoid probable causes of claims with types of people interacting with their lives essentially in our products that cover it, you then can have material and rapid adjustments to the underlying profitability of your book, right? So, if I'll pick on travel because it's a pretty relevant product for this type of thing. If we know a certain type of traveler on a certain type of trip is 10 times more likely to have a slip and fall at a pool, we can talk to those travelers while they're traveling. We can give them information that say, hey, did you know travelers like you have a 10 times more likely thing to do? And then we get immediate feedback, especially with travel, because once the trip's over, we kind of know what happened and what didn't. And then we can see what level of information to share, how to share it. Does it start to move the needle, not only on their experience, i.e. they didn't have a slip, but then obviously on our own financial experiences, of the people that we randomly controlled and communicated to, that population had a lower slip and fall incidence because of our direct and immediate and close to real-time efforts. So I do think you can do 1.1 and version 2.0 and 2.2 when it comes to interacting with the customer, even if you can't very quickly modify the product.
Yeah, it's something that just completely went over my head as you were just describing that. There's a tremendous opportunity to take advantage of the technology to not annoyingly interact with the customer, but to mitigate risk.
Yeah.
Are you saying insurance is annoying?
It can be, especially if you don't want to deal with it, if it's like that one thing, like going to the dentist, it can be, but that's, to me, what you just described, Newcombe, is probably what I would describe as the future of insurance is, I look out 10 years and I just think a paper policy, even a PDF policy, just a policy in and of itself, by itself, probably won't exist the way it does today, because insurance will be tangled, weaved in, or as we'll use Brian's presentation, it'll be infused into all of this other stuff. And I keep forgetting that, there's that opportunity to take technology and just weave it into what we're doing to make our lives easier, safer, better, whatever. So I want to ask a final question. Concern of mine would be, great. I love the technology. I love everything you guys are doing. There's going to be a conference where there's going to be others like you replicating same sort of thing at their companies. And the point is that I would expect loss ratios to drop. I fully expect that there'll be a reduction in loss ratio. But if it happens for everyone in the industry, margins are already tight. Do margins stay tight as they go down on a smaller premium base? Is it like the Red Queen from Alice in Wonderland? Are we running hard just to stay in place? Is that what this exercise is? Brian, let's start with you.
That's a really good question. So I think what you're getting at is that, look, if the entire industry is kind of getting better and having access to more pieces of information, whether it's new data streams or whatnot, is that ultimately going to drive profitability down because the pool ultimately could shrink? Maybe, but I think that's a hard question to answer. But as I think about it, I think that that's the right thing for the consumer. That's the right thing for the end customer. And as an industry, that's all what we should really be focused on. We should be focused on, doing the right thing for our customers and gaining additional customers as a result of that. I think we're on the advent of seeing larger scale shifts in the insurance industry. We see all kinds of new risks emerging. Speaking specifically to kind of home and auto, we've written the same type of policies for 100 years. And the way people use their homes, the way people use their cars was generally the same for 100 years. We're starting to see a bigger shift there. And we're starting to see the advent of home sharing. We're starting to see the advent of car sharing. We're starting to see mobility solutions emerge. We're starting to see people subscribe to cars and not own them. We're seeing just a lot of different things, a way people use these assets, and thus the insurance needs to change associated with that. Is that going to change the pool size? I don't know. But I think that it definitely changes the way we interact with our customer and our customer's experience.
Fair enough. Fair enough. Dorothea?
So I've done this for a while, and insurance generally, when it becomes cleaner and more understandable and the actuarial numbers line up, right then is when a new need surfaces in the marketplace. Mm-hmm. And for me, it was employment practices, and now it's privacy and network security, and now it's these physical features as they integrate with AI. How are we going to handle that? So I think it's just going to keep evolving, and that different coverages replace other margins, if that makes sense. That new revenues from new products will replace the lower margin levels or lower pool from the other products.
Good response. Newcombe, I'll let you finalize these.
Yeah, no, I agree with both of them. And loss ratio should come down both for us and our end customers. And then prices should come down as loss ratios come down. I see where the biggest bang for the buck, and certainly the quickest, is going to be on the other aspects of a combined ratio, where it just makes technology and innovation makes it so much more easy for our customers, our intermediaries, our brokers to do business with us and engage with our products. As that gets easier and more seamless, probably has some automation in behind the scenes, so your expense ratio starts to go down. And if it's easier for a broker to bind a policy, especially a smaller one, they're not as demanding as a high of commission. So now your acquisition cost comes down. So I think the bigger, quicker play from technology standpoint and from data standpoint is all the aspects of a combined ratio other than loss ratio. Because as loss ratios come down, prices should come down, because that's what everyone is going to want. And like it or not, people don't brag that they have the most expensive insurance. It's not the thing you call up your
status.
Yeah, you don't have an AIG on your brand on your backpack saying, "Hey, I spent more." No, we should always be trying to bring our prices down because it will sell more, and we should always be trying to bring our loss ratio down because it means that our customers are being safer and having less claims.
Yep.
So.
Oh, great. We'll leave it there. I'm going to bookend it back to Ellen. Ellen, can you give us the specifics again on the event?
Yes. So Internet of Insurance, hosted by Internet of Business in Houston, Texas, September 26th and 27th. We have about 35 speakers. We're going to have an amazing group of people. We try really hard to have like 60-40 ratio. That means we have 60% insurers, carriers, reinsurers, brokers, folks like these people, and then a really small vendor, like kind of solution provider ratio. And they have very specific areas. There's no heavy pitching. It's just so that you guys can like hear their opinions and you guys get to talk to them if you want to. So we're super excited. I think the event's going to be really fun, really interactive. And it was so fun hearing all you guys talk about your sessions. I've already heard from most of you before, and it gets me more excited to hear even more discussion.
Fantastic. So if anyone's watching this, or if you're listening to this on the podcast, go to the show notes. We'll have the link up for the event so you can go. I highly recommend it. There's really not a lot like this out in the industry. So you get to hear further. You can talk to Newcombe, Dorothea, and Brian, meet Ellen, and a whole bunch of other folks. So Internet of Insurance, the link will be up on the show notes. For Brian Gaab, Dorothea Westin, and Newcombe Clark, and of course, Ellen Dolan, thank you for watching, and we hope to see you at the conference.
Thanks, Nick.
Thank you.